In this video, we will discuss the concept of night scalping Forex robots. Stick around to the end to receive a free Forex robot from us at Prosperity Algo Solutions. So, night scalpers are a very interesting type of robot, which you may have seen previously on, like for instance, the MQL5 marketplace or on different robot or EA marketplaces. And they tend to be a very interesting strategy as they don't rely on grids or martingales or very high risk systems, and they tend to actually have a real strategy behind them. So in this video, I wanted to really dive a bit more deeply into that strategy, just to teach you guys a bit about what the premise behind these bots typically is and how you can perhaps use that for your own trading. So to define a night scalper is usually a bot which focuses on scalping really small movements around the end of the New York session before the Tokyo session really kicks off. So depending on your time zone, this would usually be between around 4 p.m. Eastern Standard Time to 5 p.m. Eastern Standard Time, and then right after the market reopens between around 6 and 7 Eastern Standard Time. And these bots are usually, not always, based on a mean reversion premise, because this tends to be a certain period of time when markets are very, very calm, there's very low volumes, so they tend to perform very well under a mean reversion type system. And because of this very unique market environment, which happens daily but for a very small window of time, many of these bots present an excellent edge, particularly if you are trading with a good broker and you have really good trading conditions, so that your edge is not eroded through transaction and trading costs, including slippage, spreads, and commissions. So to dive a little bit more deeply into the concept of mean reversion, as the name would suggest, is simply when price returns to a long-term average. So here I have a nice little chart up just to kind of show what this would look like. This is a very short moving average, so it doesn't demonstrate it too well. But effectively, as price tends to kind of push away from the moving average, during a mean reverting period, you would see a reversion back down. So price pushes away and then it kind of comes back to the moving average, and it's constantly almost tracking the moving average. And in a context like this, you would define overbought conditions as you would be going quite far up from the moving average, so you would be in an overbought zone, and you would define oversold as when you're kind of at the downside, diverging away from the moving average. And in these conditions, in a mean reversion premise, you would look to go short, so sell, when you are in an overbought condition. So effectively, if price is going up, you'd wait for it to hit a top and then you would short, whereas you would go long in an oversold condition. So let's say price went down and we are in a quote unquote oversold area, so we've deviated to the downside, we would look to go long, hoping that it would effectively revert back and return to the moving average. Therefore, a mean reversion premise tends to be a counter trend type strategy. So you're not going with the overarching trend, you're actually fighting it. And that's why this works so well with night scalpers, because in a night scalping time period, there tends to be less big trends. If you try to do this with gold at 8:30 a.m. Eastern Standard Time, where you tend to see lots and lots of news releases, this could very rapidly be a recipe for disaster, because that's more of a trending time period. But in the following slides, we'll go a bit more into detail as to why this tends to work super well. Really, the reason why this works is not due to some sort of voodoo or anything, but it's really just fundamentally driven by super low volumes. So this good chart here from VantageFX shows volumes of different times effectively. And here, like during the night scalping hours, which is towards the end of the New York session, before the beginning of the Tokyo, or even sometimes before the beginning of the Sydney session, we see, frankly, ultra low volumes in the market. And just if you look at global time zones, this makes absolute sense. So around 5 p.m. Eastern Standard Time, New York is going home, so the traders, many of them are going back to their families, and especially the big institutional guys moving lots of money, they're simply done for the day. They're having dinner with their kids, and they're not necessarily worried about putting a ton of money into the markets. At the same time, the guys in London are all very much asleep, so they're not trading in large amounts either. And Tokyo is just waking up and starting to have breakfast. So all the big institutional money isn't really moving at these time periods. So markets are going to be extremely slow. And you could argue, like, yes, the majority of trading is algorithmic, absolutely. However, algos are still based on like fundamental drivers, which also would not occur during these like super low volatility hours. Like, for instance, a lot of the fundamental drivers which move markets and algos and human traders trade off of tend to be fundamental in nature as well. So keep in mind, like, economic news releases, which would be released at 8:30 a.m. New York Eastern Standard Time. Those events are also not occurring in the evening in New York time. So a lot of these big fundamental drivers, along with capital flows, are simply not happening during these times. And because nothing's really happening in the market is going to move relatively sideways. So the mean reverting premise here is, hey, during 6 p.m. Eastern Standard Time, the market should not really be doing anything because nothing's really happening on a fundamental basis. Therefore, if we see a large deviation away from the mean, there is a statistical higher likelihood that we will then see a reversion back to the mean, just because this is due to perhaps a big order going through or some sort of like auction-based driver which is causing this deviation. But it really shouldn't be happening. Therefore, it makes perfect sense that we're going to see that reversion back. And here we can kind of wrap up on the best practices to trade this type of system. So what I have seen with a lot of the EAs and just bots in the market is that there tends to be a heavy focus on indicators for this time period. But honestly, I would be extremely careful with overusing indicators to build a night scalper. This is just because if you start to narrow your time window to a very small period of time, you're already introducing overfitting risk because you're picking not too many trades, and it's simply harder to optimize on significantly fewer trades. If you take that and you suddenly stack 2, 3, 4, 5 indicators on top of that, you just have way too many possible iterations which you can do, which greatly increases your risk of overfitting on historical data. So what I have found, and currently developing a night scalper based on a similar premise, is indicators make great filters, but you likely shouldn't use them to actually enter a position, so not as your trigger. And what that could perhaps look like would be you use the stochastic indicator, and you could use the CCI or the RSI or a variety of different indicators to tell you when you're in an overbought or an oversold region, but perhaps you would enter based on a candlestick pattern or based on some sort of like volatility trigger, which would effectively cause you to enter the market. So I have found this to really be the best practices for trading in a night scalping way. So hope you guys enjoyed this video, and stick around for the following short clip to receive a free EA from us at Prosperity Algo. Take care. Before you click away, if you're looking to get a real expert advisor, here at Prosperity Algo Solutions, we're currently offering our Golden Time Bomb system based on automating the London breakout and opening range breakout 100% for free. Watch the pinned video to find out more and to get access.